Joining me today is Charlie Jamieson of Jamieson Coote Bonds. Jamieson Coote Bonds is a specialist high-grade bond manager who, since being founded in 2014, remains focused on investing in high-grade bonds. Welcome, Charlie.
Thank you, Andrew.
Who is Jamieson Coote Bonds, and tell me about your investment philosophy?
Thank you. Well, Jamieson Coote Bonds is a specialist provider of government-only high-grade bond assets. That's designed to really complement other growth-type assets that a portfolio might hold. So we specialise in that defensive component, as you touched on. It's a part of the bond market that not a lot of people have had a particular specialisation in, but we feel it's a critical part of an investment portfolio that can defend and protect on behalf of investors and preserve capital.
So can you tell us more about high-grade bonds, how they work, their defensive attributes and their role within portfolios?
Sure. So high-grade bonds essentially refers to government-backed bonds or loans made by the government, which pay normally a fixed rate of interest. And they are very defensive because the credit quality has the full faith and quality of the government. Clearly, in times of stress, people tend to flight to those types of very secure assets where the income streams are absolutely fixed. Whereas corporate credit obviously takes the credit quality of a corporation and doesn't quite have that same credit characteristic.
Many of our clients understand how shares work and how returns are achieved by investing in listed companies via capital growth and the income that's received from dividends. In contrast, how do high-grade bonds perform, and are they as volatile as shares?
They're certainly not as volatile as shares and often actually display negative correlation benefits. So often when shares are going down quickly, bonds can be doing quite well. Not always, but very often that's the case. The income streams from these instruments are backed by the government and they're completely pre-mapped. And so you can have great surety in terms of liquidity management and liability management. And they are, of course, incredibly highly rated. So they're not particularly volatile. They are there to play a more defend and protect type role in a portfolio to help complement other risky portfolio holdings.
And can you explain how high-grade bonds perform under various market conditions, and what are some of the key reasons why portfolios need genuine defensive holdings?
Yeah, so one of the big misnomers about bonds is that they can have these potential market volatility type moments. If you buy a bond and hold it to maturity, you absolutely receive the fixed rate at which you purchased it at. So let's assume the bond yields 3% and you hold that bond until it does mature, not dissimilar to a term rate on a mortgage or the like. You will earn 3% on your money. But bonds also have the ability to appreciate or depreciate at times, but they do have the ability to generate material capital gains. And in these times of high stress, where a lot of other investment products can be under strain, bonds tend to do very well as there's very large demand to consume bonds and interest rates are perceived to be falling because there is some problem in the economy. And that's why they play that great diversification role inside a portfolio and help complement growth assets.
And finally, Charlie, given that we're in that late cycle environment that you mentioned, what's your macroeconomic view for what's ahead in the short term and beyond, and what's your outlook on interest rates, risk, and what does it all mean for Australian investors?
Yeah, clearly it looks like there's some challenges coming down the road, I guess, as a result of the Royal Commission, both in Australia and then higher interest rates in offshore markets. We're already seeing periods of quite severe volatility in many markets. And certainly with higher funding costs looking forward and less credit availability, we're already seeing the housing markets starting to roll over a little bit, particularly on the east coast of Australia. It is a point at which, in that late cycle environment, investors have had a really good run with their growth assets, and it's probably time to look at some of these more defensive alternatives to ride out the shifting structures and the change in the wind, which seems to be upon us at the moment.
Thanks very much, Charlie.
Thank you, Andrew.